Welcome back, everyone. Today on the Joseph Carlson Show, we have a busy earnings week. This week, we've already started off with McDonald's giving their earnings. Revenue came in under expectations. We're going to be going over the reasons why and what that means for the rest of the food industry. On Tuesday, we have companies like S&P Global, one of my largest positions. Then we have Shopify, DoorDash. On Wednesday, we have Robinhood. And then on Thursday, we have Moody's. Similar to S&P Global, we're going to be going over all of these companies, and I'll be giving a preview on these earnings reports. Now, of course, we also have some other news to get to. Just today on CNBC, there's a report about how Amazon AI sentiment is shifting. It's shifting for the positive. Now, I'm not one that misses an opportunity to say, I told you so. So this is something that I have been predicting for a long time. And seeing CNBC and Wall Street finally address it is something I'm going to highlight. Now, we're going to be looking at what this AI shift is, why investors are now calling Amazon a leading AI company. And then finally, yesterday was the Super Bowl. You may have heard. There was a lot of companies that paid a lot of money to advertise for the massive audience with the Super Bowl. And we're going to be going over many of the advertisements for stocks that we talk about. Ones like Booking.com or Salesforce or DoorDash or Hims and Hers. We're looking at all these companies that are paying tens of millions of dollars to advertise and seeing if that money was well spent. I'm going to be going through, playing what I think are the best ads and ranking them by their effectiveness. So as always, we have a lot to get to in this episode. Let's go ahead and jump in. Now, we first need to start off with the earnings week this week. We have the earnings calendar here, which you can have access to this by signing up for Qualtrim.com. It's included as part of the Patreon. And on a side note, if you haven't tried this out, I really think you should. If you try it out today, you get the rest of the month for free as a free trial to dip your toes in the water. Qualtrim is the website that I've developed. I own it outright to 100%, and I have full control over the development. So I know it's a quality product. When you use Qualtrim, it's really easy to use. It displays all the financials of a company in visual format. It has AI summaries of the competitive advantages and disadvantages. It has a very powerful watch list with a dip finder feature that shows you which companies are in a dip, which ones are in a price surge. You can look up the transcript of any company and see all the different quarter transcripts in text message format, or you can have the AI summarize it, so you have the entire thing summarized in a single page. I'm being honest here in saying that most of the comparable websites to Qualtrim cost $25 to $50 per month. That's 2.5 to 5 times as expensive. I offer Qualtrim for $10 per month. It is dirt cheap for what you're getting. So try it out and I think you'll love it. Now let's go ahead and start off with the biggest earnings this week. Today so far we've had McDonald's. That's the highlight on Monday. When we look at McDonald's report, I can see that right now the stock is actually trading up. So investors were expecting a little bit more subdued of a report. Even though they came in short on the revenue, investors are still okay with this. So expectations were rather low. CNBC reports that McDonald's revenue disappoints as US sales sees worst drop since the pandemic. So this doesn't look good on the surface. The earnings per share met expectations, but the revenue was notably below, $6.39 billion versus $6.44 billion. So not good there on the revenue. In most cases, when I see companies like McDonald's performing poorly, it gives me a little bit of pause for other fast food restaurants and other sit-down restaurants like Texas Roadhouse. Texas Roadhouse is a company that I own $75,000 worth of the stock. 40,000 of that is gains. So this is one that I've held for some time. I really like the establishment, the operation, and normally this would give me a little bit of concern. But in this case, it doesn't. I'm not concerned about Texas Roadhouse because of McDonald's missing their earnings, because the primary reason that McDonald's missed their earnings is E. coli. From the CEO, quote, I think right now what we're seeing is that the E. coli impact is now just localized to areas that had the biggest impact. Right now that's still weighing on their sales in specific regions, but that's going to work its way over time. We've already seen this story play out with Chipotle. It'll have a hit in sales until McDonald's regains trust. Now moving on to Tuesday, we have one of the biggest companies in my portfolio reporting earnings, and that is S&P Global. I'm going to combine S&P Global on Tuesday with Moody's on Thursday because they have such similar business models. Moody's, for example, runs a huge portion of it, which is the credit rating business. S&P Global has that same credit rating business, but both of them have differences in their analytics and intelligence business. But either way, both of these are significant investments in my portfolio. S&P Global is a $108,000 position. Moody's is $55,000. Both of them are moderately in the green. Now, why do I own these companies? I own them because they're monopolistic toll booths on the global credit rating market. which is much bigger than the equity market. S&P Global and Moody's standards are so significant now, so ingrained, that they're like a common language for rating debt. Virtually every public entity has to use one of them to rate their debt, otherwise they pay a much higher interest rate. So they have unabated pricing power. They can continue to raise their prices above the rate of inflation, and they've done so for the past decade. I believe that their moat is getting stronger over time as they continue to grow their revenue and rate more companies globally. So I like the positioning of both of these companies. Now, when we look at the valuation, and in terms of my expectations, I don't think there's going to be too much excitement going on this earnings report. The basic way that I look at this is that this company's trading for around the same price as the S&P 500 in aggregate. Yet S&P Global is a bit higher quality overall and growing a bit faster. So intrinsically, I believe that this company will outperform the S&P 500 over the next 5 years. And the same goes for Moody's. Very similar investment thesis, slight variations in their business. In many ways, this is like owning Visa and MasterCard. Now, another company reporting at the same time that I'm very excited for. This is a company that I don't own, but I really like. It's one that I've been following, and it's towards the top of my list of my top considerations for buying. That is Shopify. This is a company that I've routinely talked highly about. In fact, at one point in time, it was in the story fund. I wanted to wait until this one had a bit more profitability before adding it. When I look at Shopify, this is a company that has a history of beating earnings. I think they're going to do it again. Their earnings and revenue usually come above expectations. Shopify is a stronger company than what most people consider. Strong GMV and revenue growth. Shopify demonstrates robust gross merchandise volume. That's the amount of stuff sold on all their various customers' websites, with a 24% increase and revenue up by 26% year over year in Q3 of 2024. Investors should watch if the company can maintain or even surpass these growth figures. Now, there's other things that they highlight here, which I think are interesting, and certainly if you're invested in this company, these are important to pay attention to. The adoption and impact of new product features, enterprise growth, and B2B expansion. All of this are different growth avenues for Shopify, but the one that I think is the most compelling is Shopify is somewhat of a payment company, and they're even doing lending. Shopify lends to merchants, and then the way the merchants pay them back is with the percentage of their revenue. So Shopify has all the data of all the people doing business with them. They can say that we'll give you a loan for $500,000 or a couple $1 million, and you pay it back with just 2% of your sales. So we get that money back whether or not you want to send a check or not, because we scrape it directly from your revenue. So unlike a bank that has to sit on their hands and hope that the person they lended money to pays it back, Shopify doesn't have to do that. They have a direct line to the revenue and they can take it directly from the company. So they're giving out loans that are far easier to underwrite and approve. And this is a dynamic change. It's really interesting the way that Shopify is doing this, and I really like this business. The problem with buying Shopify today is, like many of these companies, they've traded up to very exuberant prices. People are really excited about them, but it's certainly not the cheapest deal possible. If Shopify does sell off after earnings, if we get a big minus 10% down day, I may enter into a position, but I'm happy to wait patiently for a dip in that one. Eventually it will come. Next up, we have DoorDash. This is one that's highly debated because there's a lot of pros and cons to this company. DoorDash, like many of these other companies, are investing aggressively in international expansion. So we're going to get a report on how that's going. They're leveraging the fixed costs across markets. Now, this is just the AI pointing out that they have operating leverage, meaning that they have the headquarters, all the employees, those mostly stay the same while their operations and revenue continue to grow. And because the revenue is growing faster than the rate of expenses, that's where you get that free cash flow margin. They're expanding into different verticals like grocery delivery, so they have that going for them, and they're growing in advertising. DoorDash is a stock that I like. I just like it. Like Uber, it's one that I think is going to do well. And a lot of investors don't like the company. They don't like the stock. They cite that it's a waste of money. And that's true. It is a waste of money. Anytime you order DoorDash, you know that you're overpaying. You're paying about double the price. But that's the price to have someone else deliver your food. If you don't want to pay twice as much, you can go get it yourself. A lot of people prefer that to going out and spending an hour on a weekend night getting their own food. So DoorDash continues to see this preference, this long-term preference for convenience over value or cost. And I've said that convenience trumps all, and I believe that's the case in DoorDash. People will pay a price that they know is not value. They'll pay a price that they know is a little bit more than they should if it's super, super convenient. Again, these businesses are mocked for not having marketplace fit, for offering something that doesn't have value, but the numbers speak for themselves. They're growing in revenue, they're growing in gross order volume, they're growing in the amount of trips, and they're growing in free cash flow. It has all the same issues of a company that's in the early stages. It has high amounts of stock-based comp, but the free cash flow is growing beyond that. I think DoorDash is doing just fine right now. Now, finally, we get to the last one of the week, which is Robinhood. Robinhood reports tomorrow after market close, and this company has been on a roll. They're coming out with lots of new products. The stock price is surging. Investors are super bullish on the story. It's up 369% over the past 1 year. So this has been a massive winner. The revenue continues to grow. They're getting more people using their betting, using their options. The earnings per share is climbing from the deep negative territory into the positive. I like the fundamental trajectory of this company. It's difficult for me to see Robinhood performing poorly on this earnings report. If I had a guess on this one, I think they're going to beat on the top and bottom line. So that's going to wrap up this busy week of earnings, but it doesn't stop there. Starting off this week, we also have many of the super investors releasing their 13F filings. The 13F filings means that they're releasing what they've done with their portfolio and how it currently stands today, what they bought and what they sold. Sometimes they'll release this information a little bit early, like Bill Ackman saying he bought Uber, but in most cases, we have to wait for the 13F filing. And it's finally coming out this week for many of the top investors. That means that the Super Investor Series is back. It's going to be starting this week, where I dive in, look at the full portfolio changes of these amazing investors. I give some context and insight into what they're doing. So that's going to be happening this week. Just subscribe if you want to see those videos. Now, moving on, we also have news that there's been a bit of a sentiment shift with Amazon. Now Wall Street and many investors are changing their mind about the company, saying it's now an AI stock. In fact, it's not just an AI company, now it's one of the better ones. Now it's one of the ones that should be acknowledged as a great AI company with a great AI strategy with many ways to benefit from artificial intelligence. Wall Street is just catching on to this. They've been stubborn. For months, I've been saying this. In fact, over months. I've been saying it for over a year that Amazon is one of the top AI companies, one of the biggest beneficiaries. Now we have Wall Street finally catching up. Let's go ahead and take a look at a report here. This is from CNBC just this morning.
As a lot of folks trying to make sense of whether Amazon's approach actually may be the winner here.
Yeah, so Andrew, at this point, the sentiment around Amazon's AI playbook is much more positive right now. There had been this feeling on Wall Street and in Silicon Valley that when it came to the AI race we talk so much about, Amazon was caught flat-footed, which really stemmed from its lack of a dominant chatbot. So Alexa, for example, has yet to catch up in generative AI. And then the choice to invest in startup Anthropic rather than developing its own frontier model. So the negativity has really shifted, at least from what I'm hearing. Amazon is getting a lot more credit for being what one investor described to me as the Switzerland of AI, especially, as you mentioned, Andrew, after DeepSeek highlighted the power of free open source models and then some of the falling cost in the industry. Consensus now is these models are becoming commoditized or really starting to look the same. So Amazon executives have been pretty diplomatic about this, saying cloud customers want choice. AWS has offered access to models from Meta, Anthropic, Cohere, and now DeepSeek, as well as its own Titan version. AWS CEO Matt Garman told me back in the fall when I asked him about the criticism of their AI strategy, he said, "We are willing to be misunderstood for long periods of time." So he was quoting their founder there, Jeff Bezos.
So sentiment is changing for Amazon. It's now changing. Investors are catching on. Wall Street is now viewing them as not just an AI company, but like the top one. They're saying Amazon is uniquely positioned to benefit from artificial intelligence. Now, when I see this news, it makes me laugh a little bit because I never miss an opportunity to say I told you so. But this is something that I have been saying for quite some time. Here's a post from Twitter that I made March 26th of 2024. People believe that Google and Microsoft are the AI plays. They seem to have no clue how much companies like Amazon and Netflix will benefit from AI. So I referenced Netflix there as well, which Wall Street will eventually call an AI company in the future. Just hasn't happened yet. But you're now seeing that happen with Amazon. For a period of time, investors, commentators like Gene Munster, CNBC, said that Amazon has no compelling AI narrative. And now it's the most compelling AI narrative. See how things have turned. I'll point out one more time of me referencing Amazon's AI strategy and their position. This one is from 2 months ago. The applications that Amazon has to implement AI into their business are enormous. The opportunity here is larger than most other companies. So when investors disregard Amazon or don't consider it an AI company, I leave confused. I don't understand that thought process. Amazon has every reason to be considered one of the top AI companies in the world. Not only are they intermingling AI into all of their business, they're competing with ChatGPT with Amazon Nova, they have massive cloud scale with Amazon AWS, but they're also competing on the hardware front. Now, of course, this is not the only time that I've referenced this. There's many times I've said that Amazon is an AI winner, and this is how investors can get ahead, by recognizing these type of dynamics before Wall Street and the mainstream of investors do. Right now, they're starting to recognize that Amazon is an AI winner, but they're still not fully on board. They're still not fully convinced. And I think that's going to happen over 2025. Investors will become increasingly convinced of Amazon being a massive beneficiary of all the different things AI can do with their robotics, with their fulfillment center, with their advertising, with every part of their business. So this is a company that I still think is meaningfully undervalued today, and we're going to see this AI story play out. Now, moving on, we get to the Super Bowl yesterday. And if you're like many people, you're not so invested in these two individual teams. You're more watching the Super Bowl for a social event, eating some barbecue, having some good times with some friends and family, while watching funny advertisements and a nice halftime show. That's typically what the Super Bowl is. Sometimes it doesn't deliver, sometimes it does. But in this case, I noticed that many of the companies that were advertising were top positions or companies that we discuss here on the channel. Many of them like Google, Booking, Salesforce. There's companies like Hims and Hers making their advertisements. And I wanted to go through these, rank them, and see which ones I thought were the best. First of all, we'll start off with a company that all of us know, OpenAI. OpenAI spent around $7 million for this advertisement. Now, I can't play the music because I'll try not to get copyright striked here. But they have a music from Rat-a-tat playing in the background. And this one shows the evolution of every big innovation over time. So there's like the wheel using, riding horses, farming, all this type of stuff that we've done as civilizations over time. We get into a train, light bulbs, airplanes, all these innovations, walking on the moon, the internet, computer chips, all of this, it continues on. And right here, for only a second, it has people ask questions, like summarizing stuff and, different AI related questions. And then you get to the very end where it has the OpenAI logo. It looks really clean. Now, this one is highly debated. A lot of people saying that OpenAI just wasted their money because they didn't describe what their product did. But obviously that wasn't the goal of the ad. It wasn't supposed to be a tutorial on how OpenAI works or all of their features. For people interested in that, there's lots of tutorials online. There's lots of demonstrations. They had a minute to change the feel and the look and the branding and the aesthetics of their company. And that's what they're hoping to reestablish there. And I think they did a decent job. It looks futuristic. It looks really clean. It has a cutting edge look. It looked in line of companies like Apple when you had new innovations coming out. And I think they did a good job. Now, in terms of use cases, I think they could have put a bit more in there. But overall, I think it was okay. Not the best ad, not the worst. Now, the next one we see is comparable to OpenAI's. It's Google, also advertising their AI tool, Gemini. And this is where Google has fallen short before. In fact, I've criticized Google in the past for an AI ad they made. It had a child writing a letter to their star, but they used Gemini to help write the letter, and it made it more inauthentic. So it was an ad that really wasn't taken well. A lot of people didn't like it. It made it seem like everything is going to be fake in the future. So we had to see if Google can get past that, if they can redeem themselves and come out with a good ad, especially for the Super Bowl. And they did. This is one that was apparently giving dads specifically, all the feels. There's so many comments on this video of people saying that it made them in tears. Now, getting people in tears is one thing, but it also needs to be an effective and compelling ad. The idea behind this ad is a father kind of narrating his life with the help of Gemini.
So at my last job, I was working across several different groups. You know what? Let me practice that one again.
Okay, when you're ready, tell me about the job that taught you the most.
That is Gemini talking to him. And I will say that Gemini sounds so natural. It sounds like you're talking to a human. In fact, I think the Gemini voice, if you actually use the Gemini app and use the voice feature, it sounds more fluent and natural than even OpenAI's voice. I think OpenAI still sounds a little bit more robotic, Siri-ish, Alexa-ish. Gemini sounds like a human.
Well, it was a role where I learned to take constructive criticism.
I think she oh, nope, doesn't like it.
Okay. I got pretty used to, working long hours with a small team. I got very comfortable multitasking. And I had to become really organized.
Not bad, but try rephrasing your answer to sound more confident.
Right. Okay. I was asked to make a lot of quick decisions and do a lot of negotiating. One more book.
Talk about your experiences working with others.
Oh. Well, I'm at my best when I'm collaborating.
This is such a creative idea. The people that think of this are just brilliant. That he's narrating it as though it's a job description, like what he did at his previous company, but then they show the visuals and the music of it being his family. And it's really cool how they did this.
If it's for the team, I'll do whatever it takes.
This job description you shared mentions on-the-job training.
Well, I am a fast learner. I don't always have all the answers, but I get the job done. A little gas. No matter how long it takes. And I'm not afraid to admit when I'm wrong.
We've all been there before. If you've been in a relationship, you've been there before. Given the I'm sorry note, you're writing out the I'm sorry text. I think it's very relatable what they're doing here.
But most importantly, I show up every day, no matter what.
All right, last question. When it comes to work, what motivates you?
I guess knowing that people can depend on me. And knowing I can depend on them too.
That's a great answer. Sounds like you're ready.
Hey James, thanks for joining us.
It's good to see you all. I've been looking forward to talking.
I'm not crying. You're crying. I'm not. Good ad for the Pixel phone. Good ad for Gemini. I think the stronger portion of this was not just the phone, but Gemini itself. It really is amazing. Now, this one next, best ad for the Super Bowl. This was it. And it's from Disney. They just nailed it. Watch this.
Sorry, folks, there's a breaking development. There's something down on the field.
I see that too. What is that?
Looks like a koala or a dog or a...
They're all out there right now. They're trying to catch it. They're having a real hard time. They've got trash cans.
This guy's got no chance.
I think they got it. Nope.
Now he's gone and driving a cart. Uh-oh, watch out for the goal. Oh, that thing is indestructible.
My kids were completely glued to the TV as soon as this came on. It was hilarious. Even my 2-year-old was completely glued to the TV. We actually watched it over again because she thought it was so funny. So this was super effective. A nice 30-second ad. I think Disney nailed it here. Uber Eats had a big one. This is in competition with DoorDash. I think Uber Eats is doing a great job. And they had none other than Matthew McConaughey, who in one portion or another is advertising for like half the companies I own, it feels like. But this is the one for Uber Eats.
Look, from the very beginning, football's been a conspiracy to make us hungry. Now let me tell you where it all started.
And we'll call this a pigskin. Make people crave bacon.
And everybody loves bacon.
I love bacon.
Bacon.
Ever ask yourself how Buffalo got a team?
These wings deserve a team.
Yeah. I figured out a good team name for Buffalo, Bill. Buffalo.
They had the host of the Hot Ones there. You notice that in the ad? They have a lot of stars in these ads.
Refrigerator.
Yes.
Even Peyton was in on it. Omaha! Steak. Omaha! Steak.
And they're still at it. This year, we got a halftime show presented by an apple. In a stadium named after
A salad!
Matthew, no one believes that football was invented to sell food.
It's a fun one. It's okay. Nothing groundbreaking here. Matthew McConaughey was also in a Salesforce ad. This one is related to Agent Force.
The booking app I used didn't have Agent Force, so an AI agent didn't know to move my reservations inside or know what I like to eat, which is not that.
What's up, my brother?
Oh, hey, bud!
We really needed this rain.
Right?
Agent Force helps restaurants prevent dining disasters.
Paddle on over!
It's what AI was meant to be.
This one's okay, a nice short ad, but there's some things that don't stack up. I think most restaurants know not to seat people outdoors in uncovered rain, even without Agent Force. I don't think that's a problem. They don't need Agent Force to say, hey, oh, we're not supposed to seat people outside in the rain next to a wet street. So I feel like they should have had a problem that's more relatable to restaurants. Overbooking, maybe him standing in line and him going, wow, I can't even eat here. I have to go to a different restaurant I don't even recognize. And Agent Force could have solved that. Because that's something people run into every day, is restaurants being full, they don't have a seat, the booking for it didn't have artificial intelligence to help it out. I just don't think this is going to be relatable. What restaurateur is going, the biggest problem is that I don't know if I should put people outside in the rain. It's just not relatable to anyone. Next up, we have Meta. Mark Zuckerberg is pushing his new hardware, the Ray-Ban glasses. So let's go ahead and take a look at this.
Hey, Meta, what is this artwork?
Comedian by Mauricio Catalan, worth $6.2 million.
What? What? That's a $6.2 million banana. Are you kidding? We need to find you another banana. Bananas.
Gentlemen,
What a place you have.
who eats art?
Think you're supposed to say, hey, Meta. Like, hey, Meta, who eats art? And then Meta would say, Chris Pratt.
Hey, Meta, call my lawyer.
So there we have the Meta Ray-Ban glasses advertisement. And I think it's pretty intentional what they're doing. The stars that they picked to wear the glasses, both big, manly, handsome men, not nerds. They're not nerds wearing these glasses. Manly men wear these glasses. They're cool to wear. If you wear these Ray-Ban glasses that are videoing people and, looking at everything around you, you're not weird and uncool. You're like Chris Hemsworth or Chris Pratt. So I think it's intentional what they're doing. I don't know if it's going to work. I'm not fully behind these glasses so far. I think it'll be interesting to see the type of product fit they have. But Meta has certainly identified the pain point of wearing these, which is social acceptance. One of my largest holdings, Booking.com, released this ad.
Hotels and vacation rentals, Booking.com has something for everyone.
Seashells! You got anything more boutique?
Oui, right this way.
Now we're talking.
What about something more family friendly?
Maybe a resort with a water park?
Or somewhere less family friendly?
Yep, one Vegas hotel for the bride-to-be.
What if we hate everything?
We have free cancellation. Find exactly what you're booking for. Booking.com, booking.com.
Very simple but effective ad. This one wasn't spectacular or really that different than their normal ads. It seems like they already have it down to a science at this point. Their advertising is highly accretive, highly effective. So this company already knows what they're doing, but this one was uneventful. Now, one of the most long-awaited ads during the Super Bowl that played towards the end of it was the Hims ad. And this is one that was under a lot of controversy. Big pharmaceutical companies actually tried to stop Hims from airing this ad because it's highly critical of the pharmaceutical industry and they didn't want them to have this exposure. Hims is a smaller company by market cap than many of these pharmaceutical giants. It competes directly with them by offering compounded versions of their same drugs at discounted prices. And Hims is a subscription business. It's like Teladoc, but they're doing it a lot more effectively. They're growing quickly. And this is the long-awaited ad that they played during the Super Bowl. Just having this ad played made the stock go up 5% today. So let's go ahead and take a look.
Obesity is America's deadliest epidemic. 74% of us are overweight, and obesity leads to 500,000 deaths each year.
Why, you just have to stop eating, Jimmy.
Something's broken, and it's not our body. The weight loss in America.
Like and subscribe.
A $160 billion industry that feeds on our failure. There are medications that work, but they're priced for profits, not patients. This system wasn't built to help us.
The whole first half of the ad is that the system is working against you. People are more chronically ill, they're overweight. It wasn't this way only 30 years ago. What changed? Well, the system changed. And they're pointing out all of this. In many cases, it goes right along with this health movement with RFK Jr., the MAHA movement. They're really capitalizing on that, I think, in a very effective way. And then they transition over to their solutions. So we get to Hims and Hers.
Hims and Hers offers life-changing weight loss medications, doctor-trusted, and formulated in the USA.
They effectively describe what the product does, how it works, how it's cheaper, how there's an app for both women and men. You can download it right now. And this is a super effective ad. Now, there's a lot of debate whether or not Hims is really all that different than the pharmaceutical company, because what they're doing is just selling drugs, mostly just at a cheaper price. So it's not really that different than the people they're criticizing. And I'll give you that, but in terms of the effectiveness of the ad, I think this is one of the best. The first half identifying the problem, the second half offering the solution. This caused an enormous spike in interest from Google Trends to app downloads from Hims and Hers. In terms of what this company was wanting to accomplish, I think this was the best executed. So that's going to be it for this show. Hope you enjoyed. Make sure you subscribe to the channel, and we'll have more out this week.